Money on my mind, looking for a dime. James Locke in the house, gonna help you shine.
Welcome to the Poole Locke YouTube channel. I'm James Locke. Today we're going to answer some of the Ask James questions of the day. This one comes in from Clark. He says, I'm at least 15 years away from retirement. So what stage am I in? All right, Clark. Well, if you're 15 years away, most likely you're in those accumulation years. You're still at the early stage. Now, you're going to get in those transition years really quickly, right? Because the accumulation years are where you want total return. You don't care whether it comes from the I or the G, right? Income or growth. We always talk about TR equals I plus G. Total return equals income plus growth. Total return equals I plus G, right? Of course, the income is the interest and the dividends that get spun off from an investment. And the growth is when you buy something at a certain price and hopefully it goes up in value. So in your early years, you want a total return. You don't care where it comes from. This is a critical phase where your investment strategy should be focused on maximizing overall portfolio growth through a combination of capital appreciation and reinvested dividends. Now, in the income years, you do care and you want an income first, growth second approach. The transition years are where you're slowly shifting your investment philosophy and asset allocation. So you're within a few years of those transition years, but I would say you might have as many as 5 more years to go in those accumulation years before you should really be making that transition. But that doesn't mean, that you don't, if you don't want to be cautious, right? If you start to see some of the growth names, growth stocks, growth funds start to slip a bit, you might want to make a transition to more high dividend strategies to give yourself a little protection. This gradual shift is about risk management and preparing your portfolio for the upcoming income-focused phase of your investment journey. Remember, Clark, at the beginning of the century, we had a market that was underwater for about 13 years, from January of 2000 to December of 2012. Most of that period, the stock market was underwater. So one could argue that even 13 years out of retirement, you could be stuck underwater for your remaining years. This historical context underscores the importance of strategic diversification and not putting all of your eggs in one basket. Don't throw caution to the wind. Yes, you're still in your accumulation years, but if you start to see some of the growth names start to fail you, then go to more conservative, higher dividend stock strategies. Maybe you don't have to integrate bonds yet as a general rule, but still having that in your back pocket. Being willing to focus just a little bit more on income first, if all of a sudden the markets start to look weaker, is probably a good idea. The key is flexibility and gradual adaptation. You're not quite in the transition yet. You're not in that red zone. You're not in that 20, you're not in, past that 20-yard line, but maybe you're on the 25-yard line. So your strategy needs to be a little different, with an increasing emphasis on stability and consistent income generation as you inch closer to retirement. Consider this a strategic preparation period. Start researching dividend aristocrat stocks. Look into low-cost index funds with strong historical dividend performance, and begin to understand how you'll shift your investment approach in the coming years. This proactive approach will serve you well as you navigate the complex landscape of retirement investing. Clark, thanks for that question, and keep on asking, right? That's important. Keep learning, keep planning strategically for your financial future. So great question. And if you had a question like Clark did, you can send it in to us. You can do so by emailing them to poollocke@poollocke.com. All right, let's move on to our second question, and this is from Paul. He asks, I will retire probably 5 to 12 years from now. It's all based on things that are happening in my industry. So what stage do you think I'm in? Well, Paul, the answer to your question is nuanced, especially when you're in an industry with uncertain employment horizons. When navigating retirement planning, you've got to let the shortest time horizon really be the guide. This approach ensures you're prepared for the most conservative scenario while maintaining flexibility. The question before this, right? We had someone who was 15 years from retirement, and that gave them more runway to be cautious, right? But your situation is different. With 12 years max on the horizon, you're already getting close to those critical transition years, right? You're hovering what I call the red zone of retirement preparation. Remember when I always talk about market dynamics, right? At the beginning of the century, we experienced a 13-year period where the market was underwater. That historical context is crucial. So Paul, even with your 12-year horizon, if not already in transition, you're extremely close to those pivotal transition years where your investment strategy needs to shift dramatically. And if it's possible, as soon as 5 years, then you're decidedly in those transition years and potentially behind the power curve in making that critical financial transition. Now, this compressed timeline demands immediate strategic action. So what do you need to do? As a general rule, you need to assess your financial readiness by asking a fundamental question. Do you have enough points to win the game of life financially? Specifically, if you had to retire in 5 years, could you generate enough sustainable income to maintain your desired lifestyle? If the answer is no, then the reality is you might need to remain total return focused and potentially explore alternative strategies. This could mean staying in a growth-oriented investment approach or even considering a second career to bridge any income gaps. Flexibility is key in those uncertain times. Let's dig deeper into the income generation strategy. We always discuss the 5% rule on this show, right? And here's how to apply it. Calculate 5% of your current investments and project how that might grow over the next 5 years. Then add this to your anticipated Social Security benefits, any pension benefits you might have. This comprehensive approach helps you determine if your current savings trajectory will support your retirement. If the numbers align and suggest you can generate sufficient income, then you should be making a significant transition from a total return accumulation focused strategy to an income first, growth second approach. Given your potential compressed timeline, you're arguably already 5 years behind the recommended transition point. Most financial experts suggest beginning this shift around 10 years before retirement. Your scenario demands a more aggressive and immediate reallocation of assets. I recommend a multi-pronged strategy. So conduct a thorough portfolio review. Increase allocation to dividend-producing and income-generating investments. Reduce exposure to high-risk, high-volatility assets. Consider building a laddered bond strategy. Explore stable, consistent income streams like dividend aristocrat stocks. Your specific transition should be carefully calibrated. If you feel you've saved enough and accumulated sufficient assets to win the financial game, you need to make a pretty significant and rapid transition in your investment approach. This isn't just about moving money around, it's about strategic positioning. You're not just investing, you're constructing a financial bridge that will carry you from your working years into retirement with confidence and security. Remember, Paul, retirement planning is part science, part art. It requires careful analysis, strategic thinking, and the willingness to adapt as your personal and professional circumstances evolve. Paul, that's a good question that you've come up with today, especially with that time break that may or may not be soon or later. So keep asking, keep learning, Most importantly, keep planning strategically for your financial future. Great questions today. And if you would like to send in your question, you can do so by emailing them to Locke@PooleLocke.com. And if you like what you heard, go ahead and like and subscribe to our channel. I'm James Locke, your retirement income source. See everyone next time.
Money on my mind, looking for a dime. James Locke in the house, gonna help you shine. Retirement is near, don't you live in fear. Listen up, my friend, let me make it clear. Savings in the bank.